In the world of investing, it's crucial to consider the concept of volatility, which refers to the degree of fluctuation in stock prices. When the overall market experiences a downturn, some individual stocks tend to exhibit larger price swings than others. This volatility serves as a measure of risk, with greater volatility indicating a riskier portfolio. This is where beta comes into play. In this video, we will be explaining what is beta, and how it can help you outperform the market. This is the Bullish Aristocrat. And in this channel I would like to share my investing journey, and give you all the tips and advice I wish I knew when I first started investing. So if you find that interesting, then please subscribe to the channel and like this video to help support us in reaching more people. Make sure to press the notification button to stay up to date with new videos that will be uploaded. Beta is a metric used to gauge the volatility of a security or portfolio in relation to a benchmark, typically the broader market represented by the S&P 500. It enables investors to assess the price risk associated with a particular investment. But how can we interpret this value? Beta values are numerical representations that help us understand how a stock's price movements relate to those of the benchmark, such as the S&P 500. To interpret beta values, here's a breakdown of how to understand stock betas. When a stock has a beta of 1, it means that its price movements are in line with the benchmark. In other words, if the benchmark goes up or down by a certain percentage, the stock will also move in the same direction by a similar percentage. If a stock has a beta of 2, it means that it tends to move twice as much as the benchmark. So, if the benchmark goes up by 1%, this stock is likely to go up by 2%. Similarly, if the benchmark goes down by 1%, this stock may go down by 2%. When a stock has a beta of 0, it means that its price movements are not correlated with the benchmark. In other words, the stock's performance doesn't depend on whether the benchmark goes up or down. It could go up or down on its own, based on its own factors and not necessarily following the broader market trends. Finally, a stock with a beta of -1 moves in the opposite direction of the benchmark. If the benchmark goes up by 1%, this stock is likely to go down by 1%. Conversely, if the benchmark goes down by 1%, this stock may go up by 1%. These simplified explanations give a clearer understanding of how beta values indicate the relationship between stock price movements and the benchmark. Beta is particularly useful in understanding the level of price risk for investors, especially during market downturns. A lower beta value indicates that the stock or portfolio should exhibit less volatility compared to the benchmark. This feature is highly beneficial, particularly for investors nearing retirement or already in retirement, as it helps limit potential losses against the benchmark. However, it is important to note that a low or high beta value solely reflects the size of the price movements a security experiences, and it does not imply that the security's price remains constant. Even securities with low beta values can undergo long-term downtrends. Therefore, beta is just one tool among many that investors can employ when constructing a portfolio. Interestingly, low beta stocks have historically shown the potential to outperform the market. However, let's delve deeper into this phenomenon. Conventional wisdom would suggest that low beta stocks should underperform the broader market during uptrends, while outperforming during downtrends. This expectation is based on the assumption that these stocks offer lower prospective returns in exchange for reduced risk. However, historical evidence challenges this notion. According to a study conducted by Harvard Business School, low beta stocks not only fail to underperform the broader market over time, including in various market conditions, but they actually tend to outperform it. The study compared the performance of stocks with the lowest 30% of beta scores in the US, against stocks with the highest 30% of beta scores. The findings indicated that low beta stocks consistently outperformed, surpassing the higher beta stocks by several percentage points annually. Over time, this outperformance can make a significant difference, potentially enabling individuals to enjoy a comfortable retirement rather than needing to continue working. While low beta stocks are not a guaranteed solution, the evidence supporting their long-term outperformance with lower risk is compelling. In conclusion, understanding beta provides investors with valuable insights into the volatility and risk associated with particular stocks or portfolios. The evidence suggests that low beta stocks have a history of outperforming the broader market, reinforcing their appeal for investors seeking steady returns with reduced risk. However, past performance is no guarantee of future results. So always make sure to do your research and due diligence before buying any stock. Thank you so much for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel to always be up to date with new videos that will be posted weekly.